Generation X is not only the sandwich generation, it's the highest holder of student debt, with an account balance of, on average, $44,000, the highest amongst the generations. So when the Department of Ed announced collections and default rules, it may hurt this generation the most. So today, we'll talk about how to navigate your school loans so it won't be as much a pinch on your pockets. Let's chop. When you're talking about school loan debt, the past two administrations couldn't be more different. Rules change all the time, so we have to be aware of these rule changes to better navigate our finances. Student loan rules have been in flux for quite some time here recently and now. And with the new announcements of collections and default rules, we have to address rather than avoid our student loan payments. Hi, I'm Dr. Preston Cherry, founder and CEO of Concurrent Wealth Management, where we help you align your life and money to help you live your wealth your way. All right. If you like what you see, feel, and hear on the show, as always, hit that subscribe button and share the episodes with your colleagues, families, and friends. All right. We have a lot to cover, so let's dive right in. The new rules that have been announced for school loan debt payment in May of 2025 have shocked a lot of people, using words like failure and default and collections, right? So those words don't feel well when we're talking about repaying our loans. And when I say I have some school loans as well as you do. And we advise our clients on school loan payments because they are essential to cash flow, supporting lifestyle now and in retirement later. So it's better to address rather than avoid. So let's get to the rules. Okay, before we take that deep dive into what the rules and guidelines are, let's take a quick look at what the announcement actually is. And it's about default status. And if your school loans were in default before the Biden pause, during the Biden pause, and after, which is current, then the new administration is saying we're going to start collecting on those defaulted accounts. Now, there has been pauses on student loans, and if your loans were in pause, then that's not considered default. What's considered default is 270 days of non-payment. And if you haven't made any payment across 270 days, then that account is considered in default and will have collections started on it. And with that, collections, just like in collecting quote unquote bad debt and credit card areas, etc., then that can be reported on your credit report. And not only that, the Department of Education is going so far as garnishing wages, Social Security offset, and tax reduction. So if you have a payment coming back to you, that could be garnished as well. So as we can see, it's very essential that we address and not avoid student loan debt repayment, particularly if your account is default. Now, the best way to look to see if your account is in default is to log on to studentaid.gov and also your loan servicer to see if your loan says default. Again, if it was in the pause status, not default. If it was 270 days of non-payment, default, and you're going to have to make some quick moves in order to avoid being garnished or reported to the credit agencies. Now, let's pivot on to the type of payments that you can make. There are different payments that you can qualify for, and that is one of the benefits of having your loans held directly with the Department of Education rather than a private institution. We'll talk about consolidation later, whether private or directly at the Department of Ed. With the Department of Ed, there are payment options that you can make that better fit your household. And then there are also periods of relief that you qualify for, say forbearance, etc. Now, one option that was offered during the Biden administration is the SAVE plan. And the SAVE plan is currently held up in courts and not offered as an option to pay back your loans. The SAVE option allowed Americans to lower their payments so their student loan payments wouldn't take so much of their budget and have a crunch on their lifestyle cash flow and retirement savings. So now that save is not available, let's take a look at the income driven repayment options that you have, IDRs. And you'll find that the different payment systems fit different budgets and consider what your discretionary income is at different percentages and then uses that in order to help you pay back your loans either at a quicker rate or a lower payment. So let's start with income based repayment. Income based repayment considers 10 to 15% of your discretionary income. And after 20, 25 years of repayment, then the rest is forgiven on the back end. Interest capitalizes on all these loans repayment systems that I'm speaking of. So that will be a commonality. The difference will be the amount of discretionary income that is considered for your loan repayment back. The second one is the pay as you earn, PAYE. And the payback plan considers 10% of your discretionary income, which is different from the 10 to 15% from the IBR. Now, that means less of your discretionary income is considered when calculating the payback amount. Now, this payment option is available to folks that started their school loans 2007 and forward. And then you have forgiveness if you make payments over time after 20 years rather than a 25-year window. Now, the last option is the ICR, which is the income contingent repayment. This payment considers the largest amount of your discretionary income available to pay back loans, so 20%. And with this is an option to where folks want to pay off their loans quicker and have a bigger budget, then an ICR could be something that you consider. Remember, when you're talking about selecting a payment plan, it's all about how much your cash flow is, the percentage of your budget that the school loan will take, and how you want to manage your lifestyle, perhaps make some adjustments now or have a lower payment and still keep an amount of your discretionary income. And that may take a little longer in order for you to pay off your loan and saving for retirement. These are buckets that we have to pour into and balls that we have to juggle. That is the reality. So that's why it's very important to address your student loans right now so you'll know what effect and what adjustments that you may have to make in those other categories such as lifestyle and retirement goals. Now, here's a quick tip as far as tax. Now, we're not tax advisors. That said, we're tax planners. And this is one tip that you could consider, which is your filing status. If you file married filing jointly, that means both of your income, spouse one and spouse two, is available to calculate that discretionary income percentage and contribute towards your school loan payment. If you file married filing single, then it reduces the amount of income considered for your student loan repayment. That said, it could trigger higher tax obligations year over year. Income is a good pivot to how you have to certify your income every year. It's called recertifying your income. And each year you have to report to the Department of Ed what your new income status is so the discretionary income amount can be calculated and how much money can be go towards repaying your loans. Now, not recertifying your income every year can come with consequences. What happens is that your current plan that you chose to be less of a pinch on your pocket goes away and you are shifted into the highest payment plan back. And also interest, capitalized interest can be added onto your account. So you want to avoid not recertifying your income every year. Now, let's talk about interest because with school loans, interest capitalizes and compounds very quickly. And this is one of the essential elements of the struggle of paying back school loans. Or when does interest start? Well, it starts immediately when repayment begins. Now, when you were back in school, even when you were in school, loans were unsubsidized or subsidized, meaning that interest was either capitalizing or not. And then after you come out of school, then interest has been capitalizing all the way up until the pause. And now that the pause is off, capital interest is capitalizing again. Interest continues to capitalize during your repayment period, default, deferment, or forbearance. So Even though you're getting some temporary relief, if you apply for it, interest continues to capitalize. This is the main reason why addressing your student loans rather than avoiding them is very essential, because the amount that you have can continue to rise and become a more of a strain on your budget and your goals. That's a good pivot time over to forbearance, because forbearance is an option that's available to you if you have your loans directly held at the Department of Education and gives you temporary relief from paying on your school loans. That said, interest continues to capitalize during this time, so you're not paying. That said, the loan amount is growing because of the interest. And this is one of the critical elements of getting some temporary relief. It's good. It's good to take it if you need it. That said, it's also good to re-engage with your student loan payments so you can pay on principal and interest. Now, the administrative forbearance that was happening right after the Biden administration has since ended. So there's no administrative forbearance anymore. You have to apply for the regular forbearance now. And while your loans in forbearance, not only are they capitalizing on interest, it doesn't qualify for, if you qualify for public service loan forgiveness, those forbearance months do not qualify or apply to the PSLF. Now, another thing to consider is if you are eligible for a deferment, and this is mainly for military or extreme hardship type of situations. And in that case, then interest is not capitalizing with deferment, but for sure for forbearance. Okay, so what is that funny acronym PSLF? That is Public Service Loan Forgiveness. And if you are working at a public institution, qualified public institution, and you're doing these three things, then you could have the balance of your loan forgiven at the end. You must be on an IDR payment program. You must submit your PSLF form every year, and you must make 120 on-time qualifying payments. And after all of those are done, after those 120 on-time payments, then you can have your loan forgiven at the end of that period. Currently, there has been no changes to the PSLF system. That said, if you are in default, forbearance, or deferment, none of those time periods where you're receiving that relief qualifies as an on-time payment. Now, let's talk about default status. Now, default status doesn't feel good, brings about a lot of anxiety and worry, but there are solutions to help you get through this process. One is to get back onto a qualified IDR plan and bringing your account current. Another solution that's being offered right now is loan rehabilitation, and that is making 9 months of on-time payments. And after that time has passed, then your account is rehabilitated and no longer being reported to the credit bureaus. This is a one-time offering only, and you can't do loan rehabilitation more than once. So when you get on a loan rehabilitation program, be focused and committed. Loan rehabilitation is one of those ways that helps bring your account back to life. Stop being reported to the credit bureaus and fear of having your Social Security, your wages, or your tax refunds garnished. Now, another way of getting your loans out of default, or if your loans are current and making them more manageable, is a loan consolidation. Now, there's some pros and cons to loan consolidation. However, the biggest pro is consolidating all of your loans directly held at the Department of Ed, and then qualifying for these relief systems that may relieve challenges in the short term. For example, forbearance, deferment, right? All of those relief options are available for those that have their loans directly held at the Department of Education. Now, two drawbacks of loan consolidation is that you may have recapitalized interest on your account, so adding on to your balance. Also, depending on the type of your loan, it could reset your forgiveness timeline when you are on your way to 25 years. It could potentially reset that timeline. Depends on what type of loan that you have. Woo, that's a lot of information where we're talking about school loans and getting back current or remaining current on your student loan repayment journey, and particularly for those in Gen X that are in the high income earning years that are trying to enjoy lifestyle, perhaps taking care of adult children and funding their retirement and aging parents and much, much more. Another line item in the budget growing exponentially could hurt those other areas. So these are reasons to address your student loan situation and not avoid it so you can take the action necessary that works best for your household and to help you continue thriving in your life and money journey. All right. That's what I got for you. If you like what you seen, heard, and feel on the show, hit that subscribe button and share the episode with your family, colleagues, and friends. And be sure to comment in the comments. We want to hear from you. What's your student loan situation? What else do you want to hear? And how can we pass along information? All right, that's what I got for you. Until next time, we'll chop soon.